If the financial system collapsed tonight, where would you run with your money? Because that question isn't hypothetical anymore. Over the past century, every major crisis created two groups. One got rich, the other lost everything. The difference wasn't how much they had, it was where they kept it. 1929, gold holders survived. 2008, cash savers stayed calm. 2020, Bitcoin believers multiplied their wealth, but this time is different. Gold lost 2.5 trillion in 2 days. Bitcoin dropped 13% overnight. The dollar faces de-dollarization, so where do you hide now? In the next some minutes, I'll analyze 5 safe havens with real crisis data. Stay until the end to find your strategy. For 5,000 years, gold has been the number one choice when the world falls into chaos. From Egyptian pharaohs to modern central banks, gold has been the symbol of stability, the asset that never fails, the ultimate refuge. Look at the track record. In 1929, when the U.S. stock market lost 80% of its value, gold held firm. People who owned gold didn't just survive the Great Depression, they came out stronger. Fast forward to 2008. When Lehman Brothers collapsed and the entire financial system was on the edge of destruction, what happened to gold? It surged 25% in just 6 months. Then came 2020. During the pandemic, while businesses shut down and unemployment skyrocketed, gold hit an all-time high of $2,067 per ounce. The pattern was clear. When everything else crumbles, gold stands tall. That's why central banks from China to Russia have been stockpiling it for decades. That's why wealthy families pass it down through generations. Gold is trust. Gold is certainty. But then October 2025 happened, and what seemed impossible became reality. Gold lost $2.5 trillion in market capitalization in just 2 trading days. The price crashed from $4,375 per ounce down to $4,042, an 8% drop, the sharpest decline since 2013. And people who thought gold was untouchable suddenly realized nothing is guaranteed. Why did it happen? 3 reasons. First, real yields spiked. When interest rates rise faster than inflation, the opportunity cost of holding gold becomes too high. Gold doesn't pay dividends. It doesn't generate cash flow. So when you can earn real returns in bonds, investors dump gold. Second, deleveraging. Hedge funds that had borrowed heavily to bet on gold were forced to sell when margin calls came. They needed cash fast, and gold was the easiest thing to liquidate. Third, the de-dollarization panic backfired. When the dollar weakened, even gold got caught in the selling wave as investors scrambled for liquidity. If the safest asset in the world can lose 8% in 48 hours, what does safe even mean anymore? Here's the balanced truth. Gold is still the top choice for central banks. In 2025 alone, they bought 710 tons. It has deep liquidity, global recognition, and a 5,000-year track record. But it also has weaknesses. Short-term volatility is higher than people expect. Physical storage costs money, and it generates zero income. Gold protects wealth, but it doesn't grow it. Hit that like button and subscribe if you're still with me. The crypto community calls Bitcoin digital gold, but in October 2025, when gold lost 2.5 trillion, Bitcoin also dropped 13% overnight. So is it really a safe haven, or is that just marketing? Let's look at the research. Campbell Harvey from Duke University published a paper in September 2025. His conclusion? Bitcoin is not a safe haven asset. It tends to move with risk assets, not against them. The data backs this up. Bitcoin now has a correlation of 0.76 with the NASDAQ. That's higher than ever. When tech stocks fall, Bitcoin falls harder. When they rise, Bitcoin rises faster. That's not a hedge. That's amplification. October 2025 proved it. Bitcoin crashed from $126,000 down to $104,800 in just 5 days. $19 billion in liquidations wiped out leveraged positions across the market. People who thought they were hedging with Bitcoin learned the hard way. When panic hits, Bitcoin doesn't act like gold. It acts like a tech stock on steroids. But here's where it gets interesting. Bitcoin operates on a 2-speed system. In the panic phase, gold is the first choice. Investors dump Bitcoin to raise cash. But in the recovery phase, Bitcoin bounces back faster than gold and attracts capital looking for upside. After the October shock, Bitcoin ETFs like BlackRock's IBIT pulled in $21.5 billion by the end of 2025. Institutional money came flooding back. This pattern has repeated before. In 2020, during the pandemic crash, Bitcoin fell 50% in the first wave of panic, but 12 months later, it was up 300%. In 2022, when the Fed raised rates aggressively, Bitcoin dropped 70%, yet it survived. It didn't go to zero. And by 2024, it was hitting new all-time highs again. People look at Bitcoin going up 300% and think this is my chance to get rich. But when it drops 50% in a week, they realize this isn't a shelter. It's a battlefield. Bitcoin doesn't replace gold. It's a completely different asset class with volatility 2.2 times higher than gold, but also return potential 10 times greater. It has a fixed supply of 21 million coins. It trades 24/7 with no central authority controlling it. The ETF infrastructure is growing stronger every year, but the risks are extreme. Volatility that can wipe out portfolios, a short track record compared to gold's millennia, technical risks like hacks and lost keys. In every crisis before this one, the answer was always the same. Hold US dollar cash and buy Treasury bonds. That was the playbook, the safe move, the guaranteed shelter. But in 2025, these assets aren't providing safety anymore. They're creating the crisis. Let's rewind. In 2008, when the global financial system was collapsing, what did investors do? They ran to the dollar. The greenback surged as everyone scrambled for liquidity. In 2020, we saw the same thing, the dash for cash. People sold everything, stocks, gold, real estate, just to hold dollars. The golden rule was simple. Cash is king in a crisis. But April 2025 changed everything. The ICE US dollar index fell to its lowest level in 3 years. Deutsche Bank put out a research note saying the market is reassessing the structural attractiveness of the dollar as the world's reserve currency. A process of rapid de-dollarization is underway. The dollar dropped sharply against the Japanese yen, the Swiss franc, and the euro. The currencies that historically compete with the dollar as safe havens. Then came the Treasury bond crisis. In April, the 10-year Treasury yield jumped from 3.99% to 4.5% in just 1 week. Bond prices collapsed, and here's what made it terrifying. Stocks were falling at the same time. Normally, when stocks go down, bonds go up. That's the basic hedge, but not this time. Both were crashing together. Treasury Secretary Scott Bessent called it deleveraging convulsions. Adam Tooze from Columbia University wrote, "This is the script for a truly existential financial crisis." What's happening beneath the surface? The basis trade is unwinding. Hedge funds that borrowed heavily to bet on tiny spreads between Treasury bonds and futures are being forced to sell. They need to cut leverage fast. When they sell, bond prices fall. When bond prices fall, yields rise. When yields rise, the cost of servicing America's $36.22 trillion in debt becomes unbearable. And when that happens, confidence cracks. More selling follows. It's a vicious spiral. On the surface, the dollar and Treasury bonds are risk-free assets. In reality, they're in the middle of a confidence crisis unlike anything we've seen before. When the safest assets aren't safe anymore, that's when you know the system is breaking. But let's be fair. The dollar still has the deepest liquidity of any asset on earth. It's accepted everywhere. You can convert it instantly. Treasury bonds remain the backbone of global finance, but the risks are real. Inflation erodes purchasing power, the reserve currency status is under question, and technical dysfunction in the bond market is creating systemic fragility. Like this video if you found this analysis helpful. Not everyone has the money to buy gold bars or Bitcoin, so what options do ordinary people like us have? Where can the average investor turn when the dollar is shaking and traditional safe havens are too expensive or too volatile? Let's start with foreign currencies. The Swiss franc, the Japanese yen, the euro. These aren't just alternatives. In certain crises, they've outperformed everything else. The Swiss franc is called the safest currency in the world for a reason. Switzerland's political neutrality, strong banking system, and low debt make the franc a fortress in times of chaos. In April 2025, when the dollar plunged during the tariff war, the Swiss franc surged. Investors flooded into CHF as confidence in the dollar cracked. Then there's the Japanese yen. Japan has kept interest rates near zero for decades. That makes the yen a favorite for what's called the carry trade. Investors borrow yen at low rates and invest in higher yielding assets elsewhere. But when a crisis hits, those trades unwind fast. Everyone rushes back to the yen to repay their loans. That surge in demand sends the yen soaring. In April 2025, both the yen and the Swiss franc were among the strongest performers as the tariff war escalated. The advantages are clear. Foreign currency accounts are easy to open. Liquidity is high. You can move in and out quickly, but the risks are real too. Exchange rate fluctuations can wipe out your gains. Transaction fees add up, and foreign currencies don't generate much income on their own. Now let's talk commodities. Oil, agricultural products, industrial metals. These are real assets with real demand, and they've saved portfolios before. Look at the 1970s. During the oil crisis, crude prices exploded from $3 a barrel to 10. People who held oil contracts made fortunes while stocks struggled. Fast forward to 2022. When Russia invaded Ukraine, oil prices spiked again. Those who had exposure to energy commodities saw massive gains. Commodities are excellent inflation hedges. When prices rise across the economy, the value of physical goods rises too. Food will always be needed. Energy will always be consumed. That real-world demand gives commodities a floor that paper assets don't have. But commodities come with challenges. They're highly volatile. Oil can swing 20% in a month. You need specialized knowledge to trade them well. And if you're holding physical commodities, storage costs can eat into returns. Here's the bottom line. Don't put all your eggs in one basket, especially when that basket could be the dollar, gold, or Bitcoin. After breaking down 5 assets, the answer isn't pick one of them. The answer is you need all of them, because there is no perfect safe haven. History has proven that over and over again. Every asset can fall, every strategy can fail, but the right combination, built with intention, can protect you when the system breaks. Let's recap what we've learned. Gold is the most stable long-term protector, but it can suffer short-term shocks. Use it to preserve wealth over decades. Bitcoin has massive volatility, but also massive upside potential. Use it for growth, but keep it as a small percentage of your portfolio. U.S. dollar cash and Treasury bonds offer the highest liquidity, but they're facing a crisis of confidence. Use them for short-term emergency reserves. Foreign currencies like the Swiss franc and Japanese yen can be safer than the dollar in specific situations. Use them to diversify currency risk, and commodities are excellent inflation hedges with real-world demand. Use them when inflation is rising fast. So how do you actually allocate? It depends on who you are. If you're a conservative investor who values safety above all, here's a framework. 60% in gold, either physical or ETFs, 20% in U.S. dollar cash and short-term Treasury bonds, 15% in foreign currencies like the Swiss franc and yen, and 5% in Bitcoin just to test the waters. This portfolio prioritizes preservation with minimal risk exposure. If you're a balanced investor looking for both safety and growth, try this. 40% gold, 20% Bitcoin, 20% U.S. cash and treasuries, 10% foreign currencies, 10% commodity ETFs. This gives you protection while keeping a foot in higher return assets. If you're an aggressive investor willing to take risks for bigger rewards, consider this allocation. 30% Bitcoin, 30% gold, 20% commodities, 10% foreign currencies, and 10% U.S. cash held in reserve to buy the dip when crashes happen. This strategy accepts volatility in exchange for upside potential. But no matter which group you're in, remember this: never invest 100% in a single asset. History has shown us that every asset can collapse. The best strategy isn't predicting the future correctly, it's preparing for every possible scenario. Let me know in the comments, what are you holding to prepare for the crisis? Gold, Bitcoin, or cash? Don't forget to subscribe and hit the notification bell so you don't miss the next video on protecting your wealth during uncertain times. And just a reminder, I'm not a financial advisor. This video is for educational purposes only. Any investment decisions are entirely your own. History shows us that in every crisis, some people lose everything and some people get rich. The difference isn't luck, it's preparation. Gold isn't the perfect answer. Bitcoin isn't either. Neither is the dollar, but the combination of them with a clear strategy is the shield that protects you. Crises don't ask if you're ready, they just come. And when they do, those who prepared won't panic. They'll act. See you in the next video.